most significant thing that happened in 2022 was, of course, the Russia's invasion of Ukraine. Yes, very topical, but actually it was more the response it triggered in central banks around the world. So if this time last year anyone had thought that we would have moved from a policy rate of 0.25 to nearly 5% in less than a year, I think that few people would have taken that bet. And yet that's precisely what happened after a couple of years of pandemic, pushed through unusual consumption and bottlenecks in the supply chain. Then we have this dramatic event which spikes the price of oil and gas particularly, and food, the two most important commodities. And what happens is it finally gives political cover to central banks to take back the power, which is to raise interest rates, right? For so long, they were stuck at the lower bound at zero, and there was no political excuse to hike rates, and they knew they were out of ammunition. So they did QE for a number of years, of course, taking the balance sheet of the central bank of the US, for example, to $1 trillion to $9 trillion by the time they started hiking rates last year. So they knew they were in an untenable position. They really didn't have any bullets left in the chamber to attack the next downturn, the next recession when it came. And this was really a gift in the making. So sure enough, we have the Bank of Canada last week, as we know, raised rates and then said it was going to pause. The reasoning for that, of course, is that these policy moves, whether tightening or loosening, take place over 12 to 24 months. It's something that most people sort of miss. They think, okay, we've had the tightening and now we'll get the cutting. It just doesn't work that well. So tomorrow we're expecting the US Fed to also hike interest rates, and potentially they could go again in March. The standoff right now is really between what's going on in terms of financial conditions and what the inflationary story is. So inflation is in fact coming back down. It peaked in June. We've got the trend going in the right direction. By all indications, we should see inflation CPI back below 3% by the third quarter of 2023. And that's all moving in the right direction in terms of pain relief. But the problem there is that every time the markets anticipate the Fed is coming to the end of its tightening or will soon be pausing, you get a dramatic rebound in speculative activity in financial markets, which is in effect loosening financial conditions again. So the rally that's happened in the bond market, for example, since October, has in fact been equivalent of 130 basis points of easing again. This is a nightmare for central banks. They want to walk a strong talk with respect to crushing the inflationary impulse, crushing the speculative impulse, and sort of keeping markets at heel. So any time that they see this rebound in prices and an expectation of a lot of cuts soon, you get this rebound in risk markets. Ultimately, right now, the bond market is pricing 200 basis points of cuts in the U.S. over the next 12 months or so, to the end of 24, and about 150 basis points of cuts in the Canadian term structure. So those would be very light relative to typically in recessions, you see central banks cut about 350 basis points of rate room. This time, if they're starting around 5 or 4.5, they may cut, 100 basis points, that sort of thing. The point is that right now it's not all priced into things like bonds. Bonds right now have had a deep sell-off last year, and they've rallied back some in the past few months. But it's quite likely that we're going to see central banks cut more than is currently priced in, which could be very bullish for the bond prices over the next year or so. The other thing that's going on in the background, of course, is quantitative tapering. This is the equivalent of about 200 basis points of further tightening on top of the fastest tightening cycle in human history. We've got this quantitative tapering, bringing the assets back off the balance sheet. They've reduced by about $500 billion so far since the start of this runoff that began at the beginning of in March of last year. So this is also, even if they pause in their hiking efforts and stay put, they still are tightening monetary conditions with this ongoing QT. So that is going to also impact the economic cycle and financial markets. As I say, over the next year and a half, we'll start to really feel that impact. So basically, again, back to this notion of remembering the lags. So the tightening cycle hits the economy over 12 to 24 months, and it leads things like new orders in manufacturing. So we've already seen a turn down in manufacturing in the economy. We've also seen a turn down in consumption in the household sector. Basically, the sector that's so far holding up of the four main engines of the economy is the unemployment rate is still at record lows. But we know that historically, that is a lagging indicator. And when we look at all the other indicators that are leading of the economic cycle, we see that today we've had 10 consecutive months of rising indication of recession with the leading indicators. So since 1960, you can see that every time we've had a spike like that, we have in fact had a recession start over the prior, within the next 12 months, so the thing. So contracting global liquidity, this is the monetary impulse, as I've said, the hiking that's already happened, whether they even do any more, just the hiking that's been done to date is 3 times the normal in a tightening cycle, on top of the QT that's going on in the background, taking liquidity out of the banking system. And what we see is that's contracting the money supply. We're seeing a reduction in loans in the banking system. This is separate from what's going on in financial markets, right? It's just new loans to businesses and households are contracting now all over the place in many countries. So that is a negative contraction that we actually haven't seen the extent of what's happening this negative in many decades. So sort of like 1980 style, 1981, it's about that long ago that we saw this much of a contraction in the monetary impulse. So global liquidity leads corporate earnings. So this is the other factor that is not yet priced into stocks. You know, right now we have a pretty bullish consensus in terms of the analyst community. They're typically very bullish, right? They're paid to talk bullishly about things. The problem is that we already had this record period of corporate earnings. And in fact, if you look at what they're predicting right now, they're still expecting probably 6% of earnings growth going into 2023. If we're correct that the economic picture is in fact going into a recession, then you would typically see a contraction of at least 20% in earnings. That is not priced into stocks yet. So what we saw in terms of the negative moves in stock prices in 2022, definitely some downside. The S&P coming down 20%. In Canada, much less, right? Only about 8% happened in terms of a price decline for the TSX. But what was not part of that pricing, that was all about the rate shock, right? That had nothing to do with this idea that we're going to have an earnings contraction. So when that happens, when people talk confidently about price to earnings ratios and that sort of thing, and they say, well, you know, they've come down significantly and they're, you know, the long-term average is about 16 and we're not too far. If we look forward on the expected earnings, we're pretty much at fair value. That's because they're not factoring in any downturn in earnings. So we've never had a recession that didn't whack earnings pretty hard. So you could see something like, you know, currently they're pricing in about $232 per share for the S&P 500 earnings. You could see that easily come down to less than 200, in which case you could see a repricing of the stock market significantly. The other thing is the last 4 recessions, because we went into those ones with particularly high leverage, similar as, you know, they've been adding debt, adding leverage to Wall Street and Bay Street and all the predicaments and gimmicks they've been up to. They've really added this enormous leverage to the world. So when we get these contractions, they both inflate earnings on the way up, and then you get a more violent contraction on the way down. So the last 4 recessions actually saw a 22 to 57% decline in earnings. So that would be a very significant drawdown yet to come in the stock market. If we apply anything like just even a 15 multiple, you could see, you know, the S&P 500 come off another 20% at least. And in Canada, the TSX, of course, again, is late cycle typically comes off later than the rest of the broad markets. And the reason is our oil and gas percentage, right? The 18% of that index, that is the oil and gas companies, which are late cycle. We had a big spike in the price of oil and gas, as you know, in the early part of the 2022. That was like the final straw, if you will, to spark the recessionary impulse because it pulls down the ability to spend on everything else, and it's a shock to the system. So whenever we get that kind of a spike at the all-time highs of consumption and other costs, you tend to get a pretty violent recession. So that's another thing that triggers it. And then in Canada, we have the lovely housing market, which we knew was a bug waiting for a windshield, but we really got it when they tripled mortgage rates in less than a year. So now we have this falling prices nationally, and the mainstream economists are now coming out and saying, okay, so prices are falling. We didn't think they would, but they are. Kind of like central banks saying, we won't be hiking rates until 2023, guys, so go crazy with debt. And then they come out a couple of months later and go, oh, actually, we're going to hike 3 times faster than we've ever done it before. So we have to always take the grain of salt with these comments. Having said that, we know that Canada is particularly vulnerable because we had such an exposure to this sector in terms of GDP in the last decade, because our things like price to rents is some of the worst in the world. The good news in this, the pearl around this turd, if you will, is that we have the potential to get some really good affordability back in the housing market. We know we have record multifamily residential properties coming on the market in 23. We've already got rents rolling over, and boy, do we need that to happen. But I think that we're likely to see the downturn in housing continue. Traditionally, housing downturns last about 4 years. 4 to 6, the last 2 in Canada in the early 90s and the early 80s. The prices fell for 4 and 6 years. Believe it or not, you can probably remember that if you think about it. And then prices didn't recover the peak levels for several years after that. So that's why it becomes so painful for people who levered up at the top of those price bubbles. It's hard for them to hang on long enough to sort of see the numbers come back over time. But this is exceptionally important and healthy. So I know it's not great for us real estate owners to see prices come down, but in terms of the reset needed to enable the younger people to come into the economy and be, building equity and that sort of thing, it's absolutely essential. So I actually see it as a very positive step. And for investors looking to buy real estate as an investment, what you want is lower prices, right? So that rents and yields make sense again. So this is all very constructive stuff. Lumber is already saying it's seen the writing on the wall. Remember, it went through a parabolic move during the mania of 2021 when housing prices actually doubled in many parts, like where I live north of Toronto. They doubled in a 2-year period. They've come off about 20% since then, but my point would be we're very early days into this correction, and much of the tightening, as I've said, that happened last year has not yet even hit the mortgage market yet, because not everyone has floating rate debt. A lot were fixed terms. A lot are only just coming up for renewal this year. So it's a slow-moving sort of train wreck in that respect. So lumber prices have come back down to pre-COVID levels. Just remember, yes, we've got I think the S&P was up about 6% year to date until today when it sold off again. But those type of violent moves to the upside are all part and parcel of bear markets. So we shouldn't let that sort of make us think, oh, it's all over, it's all good. We have to look at what's been accomplished by the down cycle. And yet, so far, we still have very expensive looking assets. Again, especially considering we haven't yet seen any contraction in the earnings cycle. And that's all looking forward into the next year or so. So that's just a portrait of what happened in the S&P in the 97, 2004, from the peak to the trough, so to speak. It just shows you how many of those violent counter-trend rallies, and that's all typical, and it's meant to sucker in as many people as possible. But you have to wait for a lot more confirmation before you feel that you're into any kind of constructive bottom. The NASDAQ, exciting stuff. The NASDAQ is now, it's triggered its third major signal in terms of, you see the prior highs being the 2000 tech bust top, and then the 2007-8 top, and the rolling over that's happened just recently. And look at the extension of that QE-enabled 10 years of God help us that went on, and all the dumb things in the world that people were doing with money, both in corporations and in the household. Very, very counterproductive to long-term stability. But the good news is mean reversion is alive and well. And if it plays out the way it typically has after this kind of a tech bubble, you can see the prices fall more than 50% from here. We're getting some important tech earnings this week. And I think that it'll just be sort of a leg up and then another leg down and continue. And the good news is, again, that we will have an opportunity, potentially a secular opportunity, to buy income-producing assets and risk assets. All things will be going on sale because all things went up so much in the bubble phase. So there's been no capitulation yet. This is speaking to what I mentioned at the start, that the speculative mania that went on, that was encouraged and enabled by central banks and cheap money, and the meme stock craze and all of that was very reminiscent of what we saw at the 2000 top as well. And that has really encouraged people that any time that there's a sell-off is a buying opportunity, right? Or a time to lever up and buy more on margin, or take another loan against your house, or whatever it is people think is investing, when in fact it's just really crazy, speculation. But the impulse is still alive and well. We have a lot of people talking bearishly, sentiment-wise, but in terms of positioning, we still have over 64% of portfolios basically are in equity risk type stuff. And traditionally, we don't see a bottom in the equity cycle till that's more like 40%. So that's a function of prices coming down, so the percentage allocated comes down, and also capitulation selling, when people finally throw in the towel and sell out their equities, and you get the allocation to the lowest level of the cycle, just as the opportunities are the best of the cycle, right? So we're trying to always think counter cycle, because that's how you can actually make and gain over time. So annual stock market return since 1900, I see a lot of people saying, well, the stock market was negative in 2022, so it'll definitely have to recover in 2023. In fact, in recessionary periods, it's more likely that you see a couple of years of negative stock market returns. So it's very likely you could see that in 2023 if we have this slowing global economy and the liquidity crunch, cash crunch, money coming out of assets, a lot of forced selling picking up. That could also suggest another negative year for stocks in 23. This is, again, what happened when the Fed cut rates 475 basis points in 2001 after the last tech bubble burst, right? They were at 6% or so as a Fed funds rate coming into that downturn, and they were able to cut it 475, which is more than the average cutting cycle. But after they did that, you still saw stocks fall. Gold basically held its own. Bonds rallied significantly, and the US dollar strengthened. So that is typically what happens after the cutting cycle. So it's not that when they pause, it's not when they start cutting. It's when they're almost at the very end of their cutting that you typically bet a bottom finally in these risk assets and a buying opportunity. That is really important. Right now, today, we have the steepest inversion in yield curves in the world. So they've hiked the short end so much, and the bond market keeps going, recession, growth slowing, and now we've got this very distorted yield curve. Once they start cutting the short end, that's when the whole thing flips to positive sloping again, and that is what precedes typically the bottom in the stock market. Stock market bottoms have never historically happened when you have all the world's yield curves inverted the way they are today. Just another little piece of evidence that we're probably not at the bottom of this cycle yet. And oil and gas, this is the TSX and the sectors of our main market. And energy, oil and gas, always the last hold up, the last stool proper. That certainly happened in 2022. But again, once you get into the recessionary factors, you start to see consumption plunge, and typically the price of oil and gas plunging. They've already come off significantly from the peak in March that was retested in June, but you should expect to see probably more downside in the oil and gas prices and in the producers' shares, because they're all part of the risk-on trade in this environment. So once that comes off, we expect the TSX will follow the S&P into a bear market in excess of 20% down. And commodities typically follow in this part of the cycle, right? Again, it's not that there's not long-term demand for some of these really exciting, especially the metals that are used in the green energy revolution, which is happening in the world. It's the leading thing. I'm excited about the future of that, but in the next year or so, if we're in this risk-off period, you typically don't see commodities do very well either. Liquidity contracting out of everything all at the same time. Cash is king in this environment. The loonie typically bottoms with stocks and commodities, so the US dollar typically strengthens, and the Canadian dollar rolls over, as we are a petrocurrency and still very much linked to the commodity cycle. So again, right now, you should expect to see weakness in that until you get to sort of the bottom in the stock market. And dividend-paying stocks, this is the sectors that people traditionally think of as safe havens, places to go, but they aren't going to protect you from losses. They may be more muted because they pay dividends, but ultimately they're all part of the risk-off trade, and they'll all tend to lose and hemorrhage. The good news is you can get 4.5% in cash right now, in cash equivalents. We couldn't get that since 2007. So there's a place to wait that's safe, that's actually yield-bearing right now. So that's really the upside of all that. So just remember, no permanent highs. Great companies can be terrible investments if you buy them at the wrong time. Risk moves up and down with price, not the other way around. When prices are high, it means risk is the highest, and when prices are low, risk is the lowest. Try and keep that in mind. And just remember that if you're trying to invest your life savings, you don't want to be a reckless speculator with all of them. Pair off a portion if that's what you want to do, but make sure you keep those guardrails intact. Good luck.